Good day, fellow investors. I was thinking of how to give you value to explain this investing environment. And perhaps the best way to explain investing and know what you have to do is by discussing Benjamin Graham's quote about short-term voting and long-term weighing. Benjamin Graham is famous for many quotes, but one of the most quoted by Warren Buffett is, "In the short run, the market is a voting machine, reflecting a voter registration test that requires only money, not intelligence or emotional stability. But in the long run, the market is a weighing machine." And knowing that difference makes investing easy over a life cycle. Just an example, as we are already here, Coca-Cola common stock went public in 1920, and by the end of the 1920s, the market, coldly re-evaluating Coke's futures prospects, had bettered the stock down by more than 50% to 1950 from starting 40. 1993, that single share, 2.1 million. Now that single share, and we'll see in a moment, is approximately, we calculated, 16-17 million. So this is investing. Market short term pushed down Coke 50% in 1920, and it shows how it's a voting machine, but over the long term what matters is the weighing machine. Buffett touches again on this because he is an owner of Coca-Cola, and this is from 1993. And Coca-Cola enjoyed price increases that dramatically outpaced their earnings. In the 1991 annual report, I said that the stocks of these companies could not continuously overperform their business. And this is a great example to show you the voting machine and the weighing machine. So we have Coca-Cola long-term chart. Warren Buffett bought $1 billion of Coca-Cola over 1998, with days where he was responsible for 30% of the trading volume. And then the stock went up, 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 and up. And in 1993, in the letter, he said that the stock went up too much, 350%, and that the business didn't follow. Only to wait for a little and then boom, another huge run up with 1,723% up just over 10 years. That's crazy, but it's a perfect example because after this, surely the business earnings didn't follow. And if you look at it from 2000, you had what, 20 years of zero returns. We look to the March low, even longer. So this is investing, and perhaps this line explains it the best. Here the market is voting against businesses, especially in the 1980s. Then 1999, huge exuberance, voting for stocks to go up, up, and up. Then business prevails again, voting bad, 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 not a good, spikes up and down, stock market crisis again, and now it's again positive. But if you look at the business line of good businesses, it's going just up, up, and up as the business earnings expand. Everything is as usual. However, the market is what everybody follows and not the business. Everything gets easier in investing if you learn how to weigh the business and forget about the market voting, or you use the market's voting ups and downs, pessimism, exuberance at your advantage. If we just look at the current market, if I just took a snip from Bloomberg's front page and look at what they are talking about: GameStop, current hospitalization, stocks climb to all-time high, most read, Elon Musk, Dogecoin, Bitcoin, and all news that are just temporary, just what's going on, just how can we vote on this, vote on that. Fundamentals, business fundamentals, that is boring, nobody cares, certainly doesn't lead to clicks or to as many views as others have on YouTube, but I think it's the biggest value I can give you by just discussing what really works no matter what. And currently the market is voting in exuberance, stock can only go up, and this line is a almost perfect upward trend. And since March lows of 2020, the stock market is up 72%. Over the last 12 years, it went from, what was it, 600, 700 points to the current 3,800 points. 5 times up, which is really, really insane for a stock market. I'm sure, and we'll see in a moment, that businesses didn't improve 5 times over the period. And this is very, very interesting. So this is the measure of volatility, the orange one, and a look at how it stayed elevated over the last months. And demand for short-term futures spiked high despite the stable trend and, let's say, low volatility. The volatility in general compared to historical times, the index level of volatility is very, very high, which means that a part of the market is exuberant, but the other part is really, really going for that protection that increases the cost of volatility, of course. This might be because of economic reasons. If we look at analysts, they are extremely exuberant. We have light blue, the S&P 500, and dark blue, S&P 500 earnings projections, forward 12 months earnings, and we can see that earnings in 2020, 2021 are expected to quickly reach 2019 levels. So this was just a temporary interruption, and boom, we are much, much higher and then continuing to grow. If we look at projections, this is from FactSet, we have decline in earnings for 2020, but then 2021, 23% growth. And if we look at stock market, we have ratings. 54.6% are buy ratings, 38.5% are hold ratings, and 7% are sell ratings. It's incredible how exuberant analysts are. They always go to the maximum earnings, maximum projections, and despite the statistical fact that only 30% of stocks outperform the market, for analysts, 94% of stocks are either buy or hold. This just shows you the system behind the bull market and exuberance, because everybody makes money on the bull market keeping going. And the projections for 2021 and 2022, so in 2022 earnings should already be 20% higher than in 2019, which was a good year. So the market is clearly a voting machine, and everybody is voting for exuberance with their dollars, or even better, other people's dollars. If you can risk with other people's money, then you have only upside and limited downside. But what about weighing? How do I weigh where the market is going? Where should I put my money? Well, that's pretty simply. Let's look at dividends. After all, dividends is what you can eat one day in the retirement, and those are the key components that tell you, okay, well, at what level this market is. Nobody knows whether we will vote the market higher or lower in the future, but the dividends is the return offered by the asset class, and you have to see how this return fits you, which then puts things into perspective for your life goals. If we look at the S&P 500 dividend yield is 1.51%, so this is what you have to expect. So if you put $1 million now, you get 15,000, and then taxes on top of that. If you look historically, the dividend yield was around 4-something%, and now the average is 1.51%. Perhaps it will reach 2% as the dividend yield return. However, historically, yields have been much, much higher. The low dividend yield is, of course, because of interest rates. We have interest rates at 0, which make this dividend yield very, very attractive. Compare 0 to 1.5, and stocks are ridiculously cheap. And therefore, the market is happy to pay a higher and higher multiple for stocks. So 2011, the price-earnings ratio on the forward exuberant earnings was around 10-11, and now it is 21-22. So the valuation of the market doubled. What people were happy to pay 100, now they are happy to pay 200, and that's something that lowers the dividend yield and increases long-term risks. One certainty: as the market goes higher from this point, your long-term returns will be lower. So these are the dividends in points for the S&P 500. Now we are at 57 points for the 1.5 yield. However, if we look at 10 years ago, the dividend was half of what it is now. As businesses invest, grow, you can expect 5% dividend growth over time. This was the historical average, and it's likely it will continue to be so. And this is again a key factor that you have to implement in your long-term investing weighing calculations. If we go to our intrinsic table, this is all downloadable in the description of the video below, and I have put here the S&P 500 dividend. I have put 5% growth rate over the next 5 and then to 10 years, a discount rate of 50%, and let's put that I expect a dividend return of 2%. 100 divided by 2 is a terminal dividend multiple of 50. So depending on what you expect, you can change here the terminal multiple, which leads to an intrinsic value of 3,200 compared to the S&P 500, means that from a dividend perspective, if the required dividend goes to 2%, the market for a 5% long-term return is even overvalued a little bit now. Of course, if the dividend remains low, then the market for a 5% return is undervalued. If the market starts expecting a historical dividend of 4 or 5%, then stocks can easily crash 50% or even more. So this is the key, the dividend, and you have to put into perspective, 5% dividend growth, which means that over 10 years you will likely double your dividend. So if you get 15,000 now on a million, you will get 30,000 in 2030, and those 30,000 are the key to weigh. The key you have to put into your life perspective. Thinking that stocks will go up, then you are betting your financial goals on what the bunch thinks, and the bunch invests in GameStops and things like that. So I wouldn't do that. I would use weighing versus voting, and that's what makes life easier. If you got value from this video, please click that like button, consider subscribing, and I'll see you in the next video.